tax basically arises as a result of the difference between yes, so what you are told is applying the requirement of IS 33 earnings per share. So we start with this year here, that is the basic earnings per share for the year which ended 31st of July 2022. Now, what do we need here? The first thing we must remember is the formula of computing the basic earnings per share, which is basically the pathos divided that with what? With one-offs. Divided that with what? With one-offs. And basically, I want us to start by computing this pathos. I want us to start by computing the pathos. And basically, for us to be able to save time, let's compute the pathos for these 2 years, 2022 and also 2023, because the computation is just the same. The approach of computing this pathos is the same, is the same. Now, you have to remember, how do we compute this? How do we compute the pathos? I've said we always start with the profit after tax, which can also be known as net income or the profit for the year. To this, we less a number of items, the preference dividends for the current year only. We also less the profit, which is attributable to non-controlling interest. And also we we add any loss from discontinued operations. So if you check on that information which you have there is nowhere we are given information about what? Discontinued operation. There is nowhere we are told there was a loss from discontinued operation. So let's start with this one, profit after tax. Profit after tax, where do we have that? We have that below paragraph 1, where we are given the statement of profit or loss. Can we go to where we have the profit after tax? Profit after tax should be below the profit before tax, less tax, and then below that we have the profit for the period. The profit after tax for the period. We start with that of 2022, and it's also important for us to note here that our figures are in million of shillings. So this one is for 2022, that's what you're going to start with. For 2022 is 480 million. For 2023 is 650 million. 650 million. Understand? Yes. So then to that we less the preference dividend. Where do we get the information about the preference dividend? We get this from the information we have below paragraph 2. Paragraph 2, where we given the statement of financial position extract. So because in our case there, you can see our company had issued equity shares or ordinary shares, and still our company had issued 4% preference shares. And I hope you can see the examiner has specified that these are non-redeemable. So because if we were told they were redeemable, then you have said you don't place their dividends here. So the preference dividends, basically for the 2 years, will remain the same because you can see there was no any change in the preference share capital, and the preference dividend should be 4% of the preference share capital. I hope you can see the preference shares issued at 4%. The dividend to be paid each year should be equal to 4% of the preference share capital. Preference share capital is 200. And basically, this will give us what? Will that give us 8 million? 8 million? Will that give us 8 million? 4%? Yes. So that one is 8 million. And basically, that remains the same for 2 years. And then to this, we also list the profit attributable to NCI. Do we have the profit attributable to NCI? Yes, because these are information about a group of companies. So that profit attributable to the NCI is given below paragraph 1. We should be able to go to something, or there is something given in that statement of profit or loss. We are given the profit for the period attributable to. Can you see that? Profit for the period attributable to the owners of the parent and attributable to the non-controlling interest. That's what we are interested with. The profit for the period attributable to the NCI, to the non-controlling interest. And not whatever you're given down there, because down there you can see we're given the total comprehensive incomes. So what we left here is the profit attributable to NCI. Profit for the year attributable to NCI. For 2022, that one is 60. And for 2023 is 90. Is what? Is 90. So take into account, we don't have any loss from discontinued operation. We should be able now to get our patos. We should be able to get our patos. So what will be the patos for the year 2022? It will basically be 480 minus 68. And that will give us 412. We do the same. We take 650 minus 98. And basically this will give us what? That will give us 552. So in our case, we already have what? We already have the patos basically for 2 what? For 2 years. So then I want us to move and we compute, first of all, we compute them as the one knows for 2022. And then from there, we compute the one knows for 2023. And then we compute the diluted earnings per share for 2023. But first of all, we deal with the 2022. So we compute the weighted average number of ordinary shares. Now, first of all, can we go to the last paragraph? To the last paragraph of this question. In the last paragraph, where we are given various transactions for the issue of shares, note 1, 2, 3. The first paragraph here, to during the year which ended 31st of July 2023, the following changes took place. So those changes which are given in paragraph 3 are for the second year. For the second year, they are not for the first year. So mean that during the first year, 2022, there was no issue of shares. So therefore, how do we compute the one-offs? So we're going to compute the one-offs using the information we have below paragraph 1. Can you go to, not paragraph 1, paragraph 2? Below paragraph 2, where we have the statement of financial position. Can we go to the statement of financial position for 2022? So we are given the statement of financial position for the year which ended 31st of July 2022. We are saying we have 2 years. 31st of July 2022 and 31st of July 2023. This is the first year, the second year. So we are computing the basic earnings per share for this year. We have managed to compute the one-offs, the patos. We want to compute the one-offs. I hope you can be able to recall what we said as far as the computation of this is concerned. We take the shares which were issued at the start, and then we add the other shares which were issued during that year. But basically what you have said is that the information we have in below paragraph 3, those are the shares which were issued during this year. So during this year, there was no issue. There was no good issue. If there are no shares which were issued during a certain year, the shares issued at the end of the year and the shares issued at the start are the same. And basically that is always your one-offs. That is always your what? Your one-offs. So if you're given, because you'll also come across other questions whereby you're just given shares issued at the end of the year you are told during that year, there are no other shares which were issued. It means that these shares issued at the end of the year are the same shares which were issued at the start, and therefore that will be your one-offs. Because the shares issued at the start, you have them. Were there some shares which were issued during that year? No. So therefore, in case you come across that question, then it is important for you to remember that. So therefore, can we go to the information we have below paragraph 2, and we determine how many shares had been issued at the end of 2022. So we will take the ordinary share capital of this company, or the equity share capital of the company, which is basically given as 400 million. We divide that with the par value per share, because this is the value of the shares issued. Can you be able to see the par value per share? The par value per share is 0.5. 0.5, that one is within our statement of financial position. We are told the company had issued, or the ordinary share capital of the company is 920 and 400, and inside the bracket you're told the par value per share is 0.5. Are we together? Yes. So meaning that here the shares which were issued at the end of the year were 800 million. 800 million. And take into account during this year there were no other shares which were issued. It also means that the shares which had been issued at the start here were 800 million. So therefore, in terms of how we compute this, we say that the shares which had been issued at the start automatically this year, the next year here will start 1st August. So this year started 1st of August 2021. The shares which had been issued, we refer to that as the balance brought down, were 800 million. 800 million. Our figures here are in million of shillings. These are not shillings, because these are specifically the number of shares. Specifically the number of shares. And then during that year, there were no shares which were issued. In fact, we can just confirm that from the information we have below paragraph 3. So the first transaction, number one, there were 200,000 shares which were issued. If we go to the last sentence, the issue took place 1st November 2022. 1st November 2022 is within the second year, because the second year started 1st August 2022. 1st November 2022 is within the second year. Number two, that one is, I think, is a right issue, but we will be able to see it was made on 1st Feb of 2023. 1st Feb 2023 is within the second year. Number three, 31st July 2023, the company make a bonus issue. You can see that is still a transaction for the second year. So during this year, 2022, there were no shares which were issued. So it basically means that the weighted average number of ordinary shares there were no for this year is what? Is 800,000. Is 800,000. Is 800,000. 800,000. And I think in our case, we are basically done. We are basically through. We are basically through. So what we need to do, yes, a question, who is asking a question here? So 200 in conjunction with acquisition of another business. No, and we are saying when did the first year ended? Because that's what you need to understand. And mwaka ya kwanza iliisha lini hapo? An iliisha 31st July. Kwa hivyo 1st November 2022 hiyo ni mwaka ya pili. Is that clear? Hiyo ni mwaka ya pili. And 1st November 2022 should be the second year. The first year ended 31st of July. So 1st November ni mwaka ya pili. Sawa? Yes, yes. So in our case, I think now we can move. We can move and compute the what? The basic earnings per share by basically applying our formula, PATOS, this one, 412. And remember, all our figures are in million of shillings, all of our one-offs, which is basically 800. And this will give us what? This will give us what? Let's try to add it so that we finish on time. We have 412 divided by 800. And basically this will give us 0.515 per what? Per share. 0.515 per what? Per share. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Now next, let's compute the basic earnings per share for 2023. For the year which ended 31st of July 2023. So remember, you have already computed the PATOS here. So what we need to compute is just the one-offs, the weighted average number of ordinary shares. So in this year, we have a number of transactions which took place. So what we do, we start with the shares which were issued and fully paid at the start of the second year. So the second year, we know the first year ended 31st of July 2022. The second year, you've seen, started the following day, 1st August 2022. So 1st August of 2022. So the first thing we need to do here is to determine how many ordinary shares or equity shares had been issued and prepaid, were issued and prepaid at the start of the second year. And remember, our figures are in million of shillings. Now, that is something which the examiner will not have given you, especially whereby you have 2 years, which are you have 2 years which are following each other. So because automatically the shares now which were issued and prepaid at the end of 2022 will be the opening shares in 2023. You see, at the end of 2022, the company had issued 800 million shares. So those will be the shares issued and prepaid at the start of the following year. Are we together? Yes. So the shares issued and prepaid at the start of the second year are 800 million. So then to this, what do we need to do? We need to add the other shares which were issued within the second year. We have those shares in note number 1, 2, 3. So let's go to note 2. Let's go to note 2. In note 2, we are told 200 million equity shares were issued in conjunction with acquisition of another business. These are shares issued in payment of a purchase consideration. These equity shares were issued at full market price at the date of the issue, which is 1st November 2022. 1st November. And I hope you can see how I'm recording all these transactions. I'm starting with the date, a short description, and then the amount. Or the number of shares, not the amount, the number of shares. So here we have shares. We can just refer to this as issue of shares at full market price. So the shares which were issued here were 200 million. And then you have now to remember what you have said in relation to the shares issued to pay a purchase consideration or the shares which are issued at full market price, because these are shares issued to pay purchase consideration. We have said such shares should be weighted on time basis. Multiply them with the proportion of time they were held. You can see those shares were held from November all the way to the end of the year. And tunajua mwaka inaisha 31st of July. So Fred, you're saying 2 months. No, those shares were held from November to 31st of July. Those are how many months? They are actually 12 months. We exclude which month? We exclude August, September, and I think October. Yes, I think we exclude 3 months. Yes, so this should be 9 months. We have November, December of 2022, and then in 2023 we have January all the way to July. So those are 7 months. 7 months in 2023 and 2 months in 2022. Those are a total of 9 months. So we multiply this with 9 all over 12. 9 all over 12. So this will give us what? That is basically like 3/4. And basically that will give us what? 150. Is it coming to 150? Is it 150? Is it 150? Yes. Yes. So that's basically how we treat those shares. Let's go to note 2. Note 2, we are told 300 million ordinary shares were issued for cash to the existing shareholders. Anytime you see an issue to existing shareholders and it is for cash, this is a right issue, because shares can be issued to the existing shareholders in 2 forms. It can either be a bonus issue, it can either be a right issue. But because the shares here automatically are issued for cash, these are not a bonus issue. So were issued for cash to the existing shareholders on 1st Feb 2023. 1st Feb 2023. 1st Feb, the issue price was 1.5 per share, which was represented 25% of the traded market price before the time, which was 2 shillings. Now, this is the issue of of additional shares to the existing shareholders of the company at a discounted price to the market price. So the examiner here was not specific, but it's obvious, it's upon you to know that these are right issue. These are right what? Issue, because you can see it meets all the features of a right issue. The shares are issued to the existing shareholders, and number 2, they are issued at a price below the market price. So these are right issues. These are right issues. These are right issue. Now we have said that in addition to the right issue, or once we have shares which are issued during the right issue, we need to split these shares into 2 components. Issue at full market price. And number 2, we compute the bonus what? We compute the bonus element. We compute the bonus what? Element. But basically, before we do that, there is something we need to compute here. And basically, that is something we have referred to as the theoretical X-rate price. The theoretical X-rate price, we have said, is the expected market price per share, expected market price per share after the right issue. So there is a very, very simple approach of computing this. Very, very simple approach. First of all, we determine how many shares had been issued by the company before the right issue. Before the right issue, how many shares had been issued by the company? You can't get that in the question. You can only get that from our question here. How many shares had been issued before the right issue? The shares which were issued, which had been issued by the company before this right issue, were 800 plus the shares which were issued here. Hapa ni shares ngapi zilikuwa issued? Who can tell us? How many shares were issued here? I'm told by Fred they were 150. Hapa ni shares ngapi zilikuwa issued? And Edith, Patrice, yes. Shares zenye zilikuwa issued hapa sio 150. Hapo unachukua the actual shares which were issued. The actual shares which were issued ni ngapi? Ni 200. That is another trick. If you take 150, you get it wrong. So the shares which were issued before, because these shares, remember, they have already been multiplied with the proportion of time. The actual shares issued were 200. So you take this plus this. So the shares which were issued before the right issue, zilikuwa 1,000. 1,000. And what was their market price per share? The market price per share, this one, we have it in note number 2. So the market price per share before the right issue was 2 bob, was 2 shillings. Are we together? Yes. And then how many shares were issued by the company during the right issue? During the right issue. During the right issue, as per note number 2, the company issued 300 million shares at a price of 1.5. At a price of 1.5. Sasa ukikuwa na hizo values, ukikuwa na hizi figures, to compute the theoretical X-rate price becomes quite simple. And this is the same approach you're using in FM, is only that I want us to avoid the formula. I want us to avoid cramming the formula. So what you do here, take the shares which were held before the right issue. This one, 1,000. 1,000. You multiply them with their market price, which was 2. I hope you can remember something related to this. You did something related to this in FM. And then you take the shares which were issued during the right issue. This one, 300 million times the issue price. Times the issue what? Price. Are we together? And then divide that with the total shares which were issued before and after. The shares issued before the right issue, 1,000, plus the shares issued during the right issue, 300. That is simply how you compute what? The theoretical X-rate price. The theoretical X-rate what? A price. So let's finalize on this. So we have this one is 2,000, and this is 450. 2450 divided that with 13. I hope that is what you're getting. Yes, I'm getting something close to that. 1.885. 1.885. That is now called the theoretical X-rate price. Always in these questions for theoretical X-rate price, there is a mark for that. There is a mark for this. So having that, we come back here we split these shares. Remember the formula. We have said to compute the shares issued at full market price. Compute how much amount was received by the company from the right issue. The amount received from the right issue will be equal to the shares issued during the right issue, 300 million times the issue price, which is 1.5, and then we divide that with the theoretical X-right price, which we have computed there, 1.885, and then these shares must be weighted on time basis. They must be multiplied with the proportion of time they were held. These shares, remember, they were issued from Feb. They were held in Feb, March, April, May, June, July. They were held for 6 months out of 12. 6 months out of 12. So let's work out that 300 times 1.5 divided by 1.885 divided by 2. What are you getting here to the nearest whole number? The nearest whole number, what are you getting here? 118, eh? 118. Is that what you're getting? Yes, 118. So then we compute the bonus element. Remember the formula. Recall the formula. You have said we take the total shares which were issued during the right issue, which are 300, minus the issue at full market price. The issue at full market price is not what we have here, but basically this is how we compute the issue at full market price. 300 million times 1.5 divided by 1.885. I usually advise the student, can you repeat what you have here? Majority of the students take this, which is basically wrong. You should take this before multiplying that with the proportion of time. And then you also have to remember that these shares should not be weighted on time basis. The bonus element should not be weighted on time basis. 300 times 1.5 divided by 1.885. We left that from 300. And that will give us 61 million. 61 million. Are you getting that? 61 million. 61 million. Yes. So basically that's how we deal with the right issue. And I've said these are concepts you'll come across in all questions for earnings per share. In all questions for earnings per share, you'll come across that concept. So it's better you understand how we deal with that, especially how we compute the theoretical X-right price and how we do that split. Finally, note 3, we're told that on 31st July 2023, the company made a bonus issue. 31st July, not 31st July 2023. Is that the end of the year? Is that the end of the year? Yes, actually, that is the end of the year. So our company made a bonus issue. Now, those shares automatically, you have to remember that, or in this case, it's important to note that these shares will have to be considered here because they were issued during the current year. And basically, what you have seen that such shares, are they supposed to be weighted on time basis? No. These ones will not be weighted on time basis. The shares which were issued here were 540. So we are told the bonus issue of 540 million were completed capitalizing to 70 million. So in other terms, you see, anytime the company make a bonus issue, those shares will have to be paid by the company from the existing reserves. What is the total value of these shares? The total value of these shares is 540, and I hope you can be able to remember the par value per share. Can you be able to remember the par value per share? The par value per share, which we have in our statement of financial position, can you remember that par value of 0.5? Yes. You multiply that with 0.5. So the value of these shares is 270 million. So these 270 will be paid by the company from the reserves. And actually, we are told the company paid for these shares using the retained earnings. So what we use here is not the value of the shares, we use the number of shares. The number of shares. And basically, this one, we don't have to weight them on time basis. And I think in our case, we are done. So what we need to compute now is the weighted average number of ordinary shares. We basically add all that, whatever you have here, from 800 all down to 540. So you have 800 plus 150 plus 119 plus 61 plus 540. And basically that will give us what? That will give us 1670. 1670. 1670. I hope that is what you're getting. So having done, we then finalize by computing the basic earnings per share. We take the PATOS, which I've already computed here, 552 million divided by 1/0, which we have here, 1670. This will give us what? 552 divided by 1670. It will give us 0.331 shillings per what? Per share. Shillings per what? Per share. Shillings per share. Okay. Yes, I hope you're getting that. I hope you're getting that. Are you getting the same value? Are you getting the same value? Are you getting the same value? Yes. Now we do the last part. The last part, what are we required to do? We required to compute the comparative figure for 2022 to be reported in the year 2023, given that the EPS, the earnings per share figure originally reported. Okay, that is not important. Basically, what you're required to compute in Roman 2, what you're required to compute in Roman 2, we are required to compute the restated earnings per share over 2022 as at the 31st of July 2023. So we are required to adjust the earnings per share of the previous year. So we are required to adjust the earnings per share of the previous year. Now, if you check on the earnings per share which are given in that question, in that part, Roman 2, we are told the earnings per share for 2022 was 0.525. But I hope you can see what you have gotten here. I think that question, even the other question, because this was a repetition, that is the same figure. But I think there was a problem with this figure because you can see the earnings per share for this year should be 0.515, not 0.25. So now we are required to restate, to adjust this. The first thing you need to remember is why do we adjust the earnings per share of our previous year? Remember here we have 2 years, 2023, 2022. So we adjust the earnings per share for the previous year in case during the current year, there are some bonus shares. There are some shares which were issued free of charge because you have said such shares are assumed to have been issued at the start of the previous year. And if you check on what you have computed here, you'll be able to see we have some bonus shares. Like number one, we have these 540. So those shares will be assumed to have been issued at the start of 2022. Do we have another bonus element? Yes, we also have this one. So that's why we have to adjust the earnings per share of the previous year. Recall the formula which I've given you for adjusting the earnings per share. I've said we take the PATOS, and I hope you can remember this for the previous year. Or in other terms here, we will take the PATOS now for the previous year, which is 2022. We divide that with the 1/0. Also for 2022. And to this, we add the bonus shares, which were issued during the current year, that is 2023. So if you have that formula, then it becomes very, very simple. It becomes very, very simple. The question becomes very, very simple. So because we have all the figures now, provided you can remember that. So the restated earnings per share, we will take the PATOS for 2022. We have those values here. This is basically the PATOS, the 1/0 for 2022. So the PATOS for 2022 is the 412. The 1/0 for 2022 is 800. So we have that. And then out to this, we need to add the bonus shares, which were issued during the current year. And we have that here. So we have this bonus issue, and also we have this bonus element. Those shares which you have not weighted during the current year, they must be used in terms of restating the EPS of the previous year. So to this, we will add 61, this one, and also this, and also that 540. And basically, we get what? The restated earnings per share for the previous year. So the restated earnings per share for the previous year will be 412. Okay, we have 800 plus 61 plus 540 So we take 412 divided by answer. And basically I'm getting 0.294 shillings per share. So can you confirm whether that is the value you're getting? Is that what you're getting? Is that the value you're getting here? Yes, 0.294. 0.294. Yes, so basically that is it, that what was required there. That is what was required there. I'm trying to check the other question because I've said there was a repetition of another question. This was a repetition of another question which was examined some time back. Okay, can I see the other question? Okay. And what is not clear on the right issue? What is not clear on the right issue? What is not clear on the right issue? November 2018. Yes. So this was a repetition of that question which was examined November 2018. November 2018, question 5. Question 5. Hapo kwa theory. Okay. So let us do another question because you'll also be able to see the other question. Tutatumia approach tofauti. So basically what we do, tunachukua the value of the total. Actually this one we refer to it as market capitalization. Market capitalization ni value ya share zote zimekuwa issued na company. I hope you can see what we have done. Tumechukua zile shares zilikuwa issued before, we have multiplied them with their market price. That is called market capitalization of the share. The market value of the shares issued before, you add the value of the shares issued during the right issue. Basically, that's what you have done. And then you multiply that, you divide that with the total shares which were issued. That should give you the market price of each share after the right issue. But you'll be able to understand better. Once we do another question, you'll be able to see still we will use another approach. But the concept is this. Unachukua zile shares zilikuwa issued before times their market price, and then zile shares zilikuwa issued during the right issue times the issue price. You add that value, and then you divide that with the total shares which will have been issued after the right issue. So the only tricky part ni kama hapa sasa. Ungechukua hii 150, it basically means that you are wrong. Lazima we work na zile the actual shares issued before, which will be 800 plus 200 shares. Sasa, yes. But basically, no problem, because I think we will do another question on this. Maybe you'll be able to understand. You'll be able to understand that. Sasa, yes. So I think for today, we're going to stop at that point. There are so many questions on this from those past papers, including our sitting. But if you check on most of the questions, they require the computation of both basic and diluted. So the question, for example, which I've given here is purely on a basic. I don't know whether the other question which Fred is proposing here do have the aspect of diluted. But once we meet now in our next class, what we will do, we will look on what is diluted earnings per share. What is the diluted earnings per share? We look on the steps which are involved in the computation of the same, and then we finalize. We finalize by doing a question having both the basic and also diluted earnings per share. Yes. So I want us to stop at that point. I don't know whether there is any question. I want us to stop at that particular point. Is there any question before we wind up? Any question before we wind up? Any question before we wind up? Awesome. So I think there is none. So let's stop at that point. But equally, you can also check on this question. It's basically similar to this one. Yes. So have a nice evening. We continue from there on Tuesday.